Welcome to the Wealth Studying Podcast. This is episode 456. Today is November 5th, 2024. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. Well, hey, today is the big election day. The circus will soon be over. Half the electorate is going to be disappointed. But on the Wealth Studying Podcast, politics is not our concern. We're just concerned about financial independence, because that's how we create our own freedom. So I'm not going to mention anything about the election other than the fact that I do want to mention that I will be in D.C. a week or a few days prior to the inaugural. I want to make my intentions public prior to the election because I don't want anybody thinking that my trip to D.C. is predicated on one particular candidate winning or losing the election. I'm not there to celebrate. I'm not there to protest. Like everything I do, I'll be there on business. In any case, let's talk about the stock market. We've seen volatility creeping in here these last couple weeks ahead of the election. VIX has pretty much been at or above 20, and we get some major switchbacks from day to day. Overall, I remain cynically optimistic that 2025 is going to continue to be at least a fairly good year. May not be as substantial as the gains that we've seen in 2024 because these have been extraordinary, but remember, they came off of an October low when the Federal Reserve was getting ready to raise interest rates. And you remember all the hullabaloo about that, where the Fed said they were easing. They talked about cutting as many as maybe 3 times. The market ran with that knee-jerk reaction. The stock market and investors started pricing in 6 rate cuts in 2024. Well, here we are a year later, and so far we've had 1. Now, I do think it's incredibly likely that we get another one by the end of this week, but I also think that that's going to be predicated on who wins the election. But in any case, I don't think interest rates are going to matter. I've been in the camp believing that rates are already about where they need to be in terms of nominal GDP. And I'm talking long-term rates, things like the 10, 20, 30-year treasuries. And speaking of nominal GDP, not to get too wonkish and in the weeds with terminology, but I want to talk about when a good company has a bad stock price, and it's a bad stock price because it's overvalued or overpriced. A lot of that, well, a portion of that anyways, has to do with nominal GDP. We'll get to that in a second. And I want to do this episode today because I'm receiving more questions than normal about why I'm buying certain stocks or why I've bought certain stocks, or really a lot of questions asking me to justify why I think the high price per earnings ratio or the high valuation of the S&P 500 is justified given where it's at right now, because it is historically high. The best way to look at this is in terms of earnings. And you've heard me say a million times, earnings and price per earnings ratios, fundamentals, they don't drive the market day to day or week to week, or over the definitely short term and sometimes near term. Fundamentals don't play any role because the market's just simply driven by fear and greed. But over time, what really matters is earnings. Companies that have growing and good earnings see price appreciation, and companies that have declining or stagnant earnings see price depreciation. By the way, that's why dollar cost averaging in the S&P 500 works. It has nothing to do with the mantra you hear about buy and hold. It isn't that buy and hold doesn't work. Buy and hold only works if you're holding appreciating assets. You go back 30 years ago, if you bought Sears Roebucks or U.S. Steel, and these are all pretty much companies that either don't exist anymore or, in the case of U.S. Steel, was just a fraction of itself, you could have bought and held those companies from 30 years ago and you would have made little to no money, and in some cases would have lost all your money. Because it isn't just about buying and holding, it's about holding appreciating assets. So the reason the S&P 500 works from a buy and hold perspective is because at least every quarter, if not sooner, the list of the 500 stocks in the S&P 500 changes. Good companies get brought in, bad companies get kicked out. So it's stock picking. And all the people say, well, stock picking doesn't work. Well, obviously it does if the S&P 500 does, because the stock market doesn't consist of 500 stocks. It consists of 7,000. The only difference between investing in the S&P 500 and investing in the stocks that you pick yourself is that you're choosing to pick stocks versus having somebody else pick them for you. Yeah, I digress. And let me say this before I stop digressing. It's a personal choice whether you choose to just invest in an index or whether you choose to pick your own personal stocks or whether you hire a firm like mine that picks those stocks for you. But another question I often get, and especially in terms of just buying and holding the S&P 500, people will say, well, there's too much risk in picking individual stocks. Why not just invest in the index? And to that, I don't disagree with that. It is less risky, and it's certainly a lot easier to simply invest with the index. But I believe, and this is basically my personal experience over the last nearly 40 years of investing and building my own wealth, choosing to pick individual stocks versus investing in an index is much like your career. Now, you can choose to work for a corporation or individual company, or you can choose to have your own business. Now, I would say on average, it's safer and less risky to be an employee, to work for another company, especially if that company is a big corporation. It's much less risky to do that than it is to go out on your own. And that's much like investing in the stock market. Yeah, it is riskier to invest in individual stocks. But step back a minute, again, from a financial independence perspective and a freedom perspective. And while it's riskier to start your own business, I would definitely make the argument that if you do succeed, then your freedom and your income is going to be far greater, not only than the average employee, but really than pretty much any employee other than the big, executives at the very top of the pyramid. And again, I'd relate that to investing. Yeah, you can do very well with minimal risk simply by buying and holding the S&P 500 or a similar index. But if you can pick the right stocks, you can do substantially better on your own. So the real question there is, are you just going to be average or are you going to be above average? Right? That's your choice. Hey, in any case, I'm done digressing. Let's focus on today's topic. When does a good company have a bad stock price or is overpriced? And this kind of gets back to that question about how comfortable I feel with the high multiples or valuations of the current stock market. I do have a concern that the S&P 500 is trading at 20, 21, maybe 22 times forward earnings. But I don't really lose sleep over it, and it's because of those earnings and the composition of the stock market. Again, if you look at the largest players in the stock market today and compare them to who they were or what they were, say, 30, 40 years ago, when the valuations were significantly lower, say maybe 16 or 17 times earnings back 20, 30, 40 years ago versus now above 20 times earnings, well, the big difference is that the leadership 30 years ago, companies like U.S. Steel and General Motors and General Electric and ExxonMobil, those big leadership companies, they were at best growing maybe double digits in their earnings. Usually their earnings were growing at, say, 6, 7, 8, or 9% on an annualized basis. Well, now fast forward to today, and companies like NVIDIA and Microsoft and Google and Facebook, because of digitization and technology and the improvements in efficiency and productivity, the profit per worker is significantly higher. And so these companies over the last couple of decades haven't just made 7%, 8%, 9% earnings, but they've made significantly more, a lot more. In the case of a company like Google, they've slowed down here a little bit recently, but if you average Google's annual earnings out over the last 20 years, which incidentally is about how long they've been a publicly traded company, because if my memory serves me correctly, they had their IPO in 2004. That's back when General Electric was the number one stock in the S&P 500. And you see where GE is today, and they've recovered in the last 18 months or so, but you see what a fiasco General Electric has been over the last 20 years versus how much Google has grown. And that difference is that for the last probably 15 to 18 years, General Electric has stagnant to declining earnings, and yet Google has been growing earnings on average about 20% for the last 20 years. And so when you have these tech companies that are so efficient and so productive that they're consistently growing their earnings, not only at double digits, but in significant double digits, then that warrants a higher price per earnings ratio. So in just straight high valuations, that doesn't bother me as long as there's justifiable growth. Where I do get concerned is that we know that trees don't grow to the sky. Yeah, there's big sequoias and tall redwoods, and while they're bigger than any other tree, they have a limit to their growth. From a physics and a naturalistic perspective, they can only get so tall, so big, so much in girth. The same is true of corporations. NVIDIA's earnings over the last 2 years, 18 months have been staggering, almost unbelievable. But the price increase of that stock has been justifiable because the earnings have grown, in triple digits. But that can't happen forever. At some point, a company gets so big that just because of the consequence of large numbers, there isn't enough of the economy to have it continue to grow at that rate. But for right now, these big cap, big tech, hyperscaler type companies, generally they don't seem to be overpriced because they do have growth to justify their high valuations. Now, why I choose to own or not own certain companies is I'm looking at those two key factors. I'm looking at what their present value is, their, say, price per earnings ratio, and then I'm looking at their future growth, and I'm seeing how much those two square. In a lot of ways, in a simplistic way, you can relate this to, say, return on investment. It's not exactly that way because profits compound differently, but solar panels on your home is a good way to look at return on investment. A lot of people go out and say, hey, I put solar panels on my roof and now my electric bill is $13 a month. I'm saving all kinds of money. Well, are you really? Right? It depends on what the return on investment is. Well, purchasing a stock is somewhat the similar way. Whenever you purchase a stock, you're doing so because you have claim on future earnings. So is that stock increasing their earnings by 0% every year? Are they just staying stagnant? Or are they increasing their earnings by 1%, 2%, or double digits? That's what matters. And I bring all this back to what I first started talking about was the nominal GDP. You want to look at the growth rate of the overall economy as somewhat of a comparison. If the economy is growing at 10%, and your company earnings are growing at 10%, then you're only average, you're only keeping up with nominal GDP. And so today, if you believe the numbers, and we have to take that with a grain of salt, but right now, nominal GDP is running somewhere around 4.5% to 5%. So you'll want to look at company earnings and say, are they growing at or above 4.5% or 5%? So that you're at least just keeping up with the overall economic growth. Well, if you use that kind of a filter, you may find out that some stocks that appear to be really good companies aren't necessarily that great because they're barely or not even keeping up with nominal GDP. And I'll throw out two names, Home Depot and McDonald's. These are business establishments that if you drive down any street in America, and in some cases, pretty much anywhere in the developed world, you're going to always see a McDonald's, and perhaps you might see a Home Depot outside the U.S., but definitely any community of any size in the United States is going to have at least one Home Depot in it and multiple McDonald's. So these are good, solid companies. But does that mean that their stock price is good? Now, I specifically chose Home Depot and McDonald's because while they are good companies, neither one of them is growing earnings at or above the rate of nominal GDP. McDonald's is growing somewhere under 5%, maybe 4.5%, 4.75% a year. Home Depot is only forecasted to grow over the next couple years at about 3.5% to maybe 3.8% growth per year. Well, that's substantially below nominal GDP. And yet, from a forward price per earnings basis, so not looking at last year's profits, but looking at what Home Depot and McDonald's are going to make in 2025, both of these are trading at what I would consider significantly high multiples. Home Depot is somewhere close to probably 27 times earnings, forward earnings, and McDonald's is a good, say, 25 times next year's earnings. So both of these companies, which are very good companies, are trading at much higher than just the average S&P 500 price per earnings ratio or valuation. And yet, in my opinion, these are lousy stock prices because they're way overvalued. If you ran out and bought Home Depot or McDonald's by paying more than 25 times earnings, your return on investment is almost 25 years. The earnings are growing at an increase every year, so it wouldn't take 25 years to get your money back. But it is still going to be a really, really long time. You contrast that with something like a Google, which again, their earnings have slowed down. They've grown at 20% every year for the last 20 years. Maybe they're slowing down to 17 times, 18 times earnings. But at 20 times earnings, Google is going to double its profit or has doubled its profit in less than 4 years. So if you had bought in Google 4 years ago and they were, say, just for simple math, let's just say they were trading at 30 times earnings, which seems really high, but if they were growing at a 20% rate per year, that 4 years after you bought them, assuming everything else stayed the same in terms of price, then the multiple would have dropped down to a 15 times, right? Because the earnings would have doubled and that 30 times earnings would now only be 15 times earnings. So you're earning your money back at a very high rate, which is why you buy stocks to begin with. That's how they appreciate. But if you're putting your money right now into a Home Depot or into a McDonald's, you're paying that high premium. You're paying 25, 26, 27 times future earnings. And yet those earnings are only growing at maybe 4%. That's a classic example of a good company that has a bad stock price. Again, in my opinion. And let me give you one more, and this will blow a lot of people's minds. Because this is a great company with a really horrible stock price, in my opinion. And that company is Costco. Now, hey, don't get me wrong. I said it's a great company. It's an excellent company. I love shopping at Costco. You know, whenever I have a big win in the stock market and I just have a really great day and my profits are soaring, I like to celebrate by going to Costco and get one of those $1.50 hot dogs. Hey, I know how to have a good time. And I like Costco and I like their products. They are an excellent company. But look at the stock price. Costco is growing at a much higher rate than Home Depot or McDonald's. But right now, forecasted earnings for not only next year, but out into multiple year future, their earnings are less than 10%, more like maybe 8 or 9% per year. They're growing twice as much as the regular economy. Well, yeah, that's all well and good, but Costco stock is priced at above or right at 50 times next year's earnings. So even if they're growing at twice the rate of the general economy, you're paying a substantial premium to own Costco. Now, again, it's a fantastic company, but I think it's a lousy stock price. So no, right now, Costco, even though I think it's a great company, it's not in my portfolio. And consequently, I have some other companies which are kind of dogs or, have been bad companies. Intel, Boeing, and a few others. And their stock price hasn't done well lately. And you'd say, well, why would you own those companies then? Well, again, they're not on the world-class scale of a Costco. But when I look at their future earnings and I compare that to where the price is today, I'm okay with the risk. And I think that those companies are likely to improve in the next few years. And so we could see some significant price appreciation. So I'd rather take a risk on an Intel or even a Boeing rather than buy Costco, which is a premium company, but you're paying more than a premium price. Hey, in any case, I own over 60 different stocks. Don't run out and buy Intel or Boeing because I say that it's well within my risk. In both of those companies, I just have a very small fraction of my overall wealth in either one of those companies. I believe in broad diversification because, getting back to this whole concept of what you're paying, the price per earnings ratio or the long-term future growth rate, right? The operative word here is future. I always say that I can't predict the future. No one can predict the future. And so when we look at these numbers, we have to remember they're just probabilities and they're, in some cases, just a best guess. Not me, not an analyst, not a company CEO can predict the exact future and consequently what the exact future earnings are going to be. That's why you want diversification. That's why you don't want to put all your eggs in one basket. And that's why you want to do your research to use the best available data to come up with those probabilities. Well, in any case, in the future, what's going to do better? Boeing, Intel, Costco, McDonald's, Home Depot? Well, we'll just have to find out, won't we? Hey, until then, as always, this is John Pugliano wishing you the very best returns.